Lentus Asset Management was established in 2007 with an intent on assisting individuals to build long-term wealth through customized equity portfolios. Through the use of bottom-up value philosophies, Lentus seeks to compound client wealth in excess of inflation with a low risk of capital loss. To talk on the broader emerging versus developed market issue, I'm joined by Nic-Norman Smith from Lentus Asset Management. Nick, let's look at your developed versus emerging market theory, and we're going to use two stocks to illustrate that this evening. One being on the local front, and that being Naspers, and the other on the international front, particularly in France, Vivendi. So let's start with how you're going to illustrate.
Okay, Brian, so we all know that the growth is in the developing markets, and there's stagnation and all sorts of concerns in Europe and in the States. This is a very common theme and everyone knows about it. Now the problem is, from an investing perspective, often if you try and invest in these themes, the asset prices have already moved against you and you have poor investment returns. Of course, it's very difficult to do because it's a lot more comfortable investing in a stock like Naspers that's rapidly growing in China versus a stock that's listed in France where there's socialism and higher taxes and stagnating growth and political concerns. So it's a very, very scary place to invest. And what happens is, because of that, you often see valuations pushed to such an extent that actually you can get great investment opportunities in these rather scary places.
What do you make of this? Because Naspers, being the inherent bull that you are, you probably back the growth story here, do you?
Yes, and I think some people seem to be valuing Naspers looking at the forward PE ratio, price to earnings ratio, and obviously that's very high. But I question whether that's the way to do it, because really I think the way to look at it is discount to net asset value, taking into account the valuations of the share that you mentioned in China and also the Russian company. It also makes up, I think, 10% of its net asset value. And if you look at that, I think it's still trading at over a 25% discount to its valuation.
And so the question then comes in, well, that's great. Discount to it's the discount to an asset. Is that asset fairly valued? And if you look at Tencent's valuation, it's on a price to earnings multiple of around 38 in a business that doesn't have massive barriers to entry. So it's all very well looking at something, yes, it's cheap.
So investors who got overexcited about Tencent is actually what you say?
Well, absolutely, and that makes up the vast majority of Naspers. The other assets are great. The DStv assets are fantastic cash-generating businesses, but unfortunately the market is shot. Market valuation of Naspers is shot way over that. Now you look at something like Vivendi. So it's a French-listed business, quite similar to Naspers in a number of ways. It has a cash cow business in pay TV, Canal Plus, which is a French pay TV, the French DStv. They've also got a whole lot of African assets, and then they've also got they own the second biggest telecoms company in France. They've got a publishing business like Naspers does, music publishing. They own Universal Music. So again, Naspers has the print assets, which are kind of dying, and Vivendi has the music assets, which are under a lot of pressure. They also have Activision Blizzard, which is a PC games manufacturer, so there's the online gaming similar to Tencent and some of those assets. But yet if you look at the valuation of Vivendi, 6 times free cash flow, 6 times earnings, and a dividend yield of around 7.2%, versus Naspers, dividend yield of 0.5%, 48 times earnings, I think, and around 40 times free cash flow. So yes, Naspers is the most exciting business, but wow, that's a massive discrepancy.
If you're seeking value, then surely you've got to go with the Vivendi story.
Well, which share is going to give you the best growth over the next 5 years, not the 1 year or 2 year, next 5 or 10 years? Which management team is going to deliver more shareholder value over the 5 to 10 years? I
think the underlying businesses, Naspers is definitely going to grow, but I'll take you back to a stock I've talked about many times, Intel. Intel, from 2000 to 2012, has grown its earnings around 4 times, so grown fantastically. Unfortunately, as a shareholder, you're still underwater because too much growth was priced into the share price. So yes, I'm not doubting that Naspers is the most exciting story. Definitely got better management, fantastic business, but you're paying such a massive premium, and history has shown, the research has proved that the high PE growth stories tend to underperform the market, and we think this is the same here.
How long do you need to illustrate that this theory is going to have traction?
as short as possible. But no, I mean, this can take a couple of years. You know, we don't know how the value is going to unlock. They could go in and unbundle all of the underlying assets. That would be a great value unlock. They could, you know, Old Mutual's a nice similar story. Very, very poor historical capital allocation, massive discount to embedded value. And you had to sit in it for a while, but you know, the value...
And you were patient with Old Mutual,
well, we unfortunately missed the Old Mutual. So
you missed the Old Mutual. How can you throw forward to an example that you missed the boat on? That's shooting yourself in the foot.
You've got to learn from your mistakes.
Shooting yourself in the foot, on the desk.
Well,
did you miss the boat on Old Mutual?
No, we
by
didn't.
The way.
Thank goodness we didn't. We were very impressed with management. The management that took over, I think, 3 years ago, and they kept on delivering on what they were saying and over-delivering.
But did you buy it for around 80? We're just changing.
Oh, no, not that.
You didn't buy. You thought that it was going to go belly up at that point, didn't you?
No,
along with the rest of the market.
No, but we didn't buy then. We bought more like 12, 13.
But Bronwyn, at that stage in the market, we were buying a much more high-quality business, American Express, at around $10, and that's at $60. So
you've saved yourself.
Sure,
well done. Came back with the star performer there. You bought a $10 American Express, and it
well, to be honest, we started at 30.
You started at 30.
Bought all the way down to 10. We were incredibly nervous and felt like fools at 10. But at 60, we're feeling a lot more smart.
I'm sure you are.
Well
we like
done.
your honesty. That's a good return. You can't argue with that. What else can we use to illustrate this example? I know we've had this discussion repeatedly.
Yeah. So the retailers are an obvious one, and we've discussed those before. Sainsbury's in the UK at book value versus versus mass market at 8 times book. Dividend yields have basically inverted. So it's the same story in so many stocks. Having said that, I'm not completely against the local market. There's some attractive opportunities. We think the platinum sector is going to provide some strong investment returns. Some of our local casinos. If you compare those to the foreign casinos, they've got much worse competitive positions. So there's some value locally, but more broadly, there's a lot more value and a lot higher quality businesses in the offshore markets.
Just looking at that theme, you're saying that there's better value in the local casinos, in the gaming industry locally than offshore. Have you bought into the likes of a Sun International? What are you buying on that front?
We started buying Sun International recently. Another interesting value unlock story, if you want to look at a conglomerate, is HCI. HCI's main asset is Tsogo Sun, which again is another undervalued casino. So there's a way of buying Tsogo Sun at a discount, and HCI have proved to be quite astute allocators of capital. So it's highly likely they'll do some good deals. You get to own ETV and various other assets within that. Now, the reason that I say the local casinos are so much better is that if you look at some of their competitors, the ones in the States and in Macau, which is sort of takes on the Chinese aspect, there's such massive competition that those margins in those casinos are absolutely dead because there's a number of licenses, and the cost of keeping those casinos in Vegas going is astronomical, and you've got huge competition. Versus locally, the assets are held amongst basically 2 gaming companies.
It's not a very mature industry locally.
Yeah, and the barriers to entry regulatory-wise are massive. And that's why we think that's fantastic. Versus a retailer, there's virtually no barrier to entry to buy a retailer.
Well, this is an interesting theme unfolding here. The likes of Tsogo Sun, Sun International.
Yeah.
We know Sun International has been under pressure for a long period of time. Would you be buying into these stocks?
Yes. I mean,
Lentus Asset Management is.
Yeah, I mean, Sun International is trading where it was, I think, 7 years ago. Now, that doesn't mean it's a buy necessarily, but it is. You know, if you looked at how much you would have to pay to replicate its current assets that it's holding, it would be a heck of a lot more than the current share price right now. In other words, just from that point of view, it's very undervalued. And City Lodge was a similar situation 6 months ago. It's had a big jump since then. So replacement of current assets, of current holdings, does look very good value, I must admit.
And from a competitive perspective, why would anyone come in and start new casinos? This is assuming they could even get the licenses, when you could buy the existing assets at a massive discount. Whereas if you look at some of the other businesses, you're paying a massive premium over the replacement value of them, and you're saying, well, what am I getting for that? And in many cases, very little.
Let's move on now. I just want to get your thoughts on the SACI business confidence numbers. We had this debate a little earlier on the desk in Business Tonight, where they are trending lower. and both Paul and Jonathan were relatively perturbed by the disparity this shows over the perceived environment, the healthier environment that we're supposed to be in South Africa.
Numbers.
The hard numbers, all right, the hard numbers. Economic growth, etc., etc. Do you believe that we're in for tougher times? Because this is a leading indicator. Businesses, people on the ground are seeing something potentially scary out there.
Yeah, I must say I'm less surprised because I don't think we went through nearly as tough a time as the developed markets did. And I think a lot of that is because we've had record low interest rates, which has helped people tide themselves over. So people who overextended themselves with their mortgages have been able to draw down on them. They've been able to get great consumer credit from Capitec and African Bank. And my massive concern, we don't try and forecast what's going to happen in the short term, but my massive concern is, well, as you mentioned earlier, if interest rates go up, and as sure as night comes after day, interest rates will go up, what is the consumer going to do? And I think they're going to be under a lot of pressure because, you know, if interest rates go from 7 to 10%, your bond repayments are massive. And we all know how much South Africans love their fancy cars and their massive houses. And there's a big concern and that'll obviously have a knock-through effect on everyone. And the biggest place that's going to get hit is someone like the retailers.
This could be the reversal of the positive story, unfortunately. I don't want to leave it on a negative note here because I know you like to turn things around. So give us the upside of this story. You're not concerned about the South African consumer?
Look, around the world, interest rates are being cut, things are being loosened all over the place.
Yeah, but there's not much more room for them to go.
Well, we said Australia's gone down to 3 3/4, we're at 6.
But let's look at the US, okay? US house prices are down 35% and they haven't even hit the bottom yet. They've dropped again. So what that means is the assets that are backing up the borrowing in the States, a lot of that pain has been felt. Our house prices, yeah, they've stagnated in real terms. Now it looks like they're growing again. There's still a lot more downside risk in a lot of those assets. So I'd be much more happy investing in the US consumer who's gone through so much pain already than ours, who's still looking pretty good, and we don't really think anything bad's happened in the world.
All right, now before we let you go, the best value in the South African equity space that you can pinpoint right now. We've spoken about the gaming industry. What would that be? Is there something that stands out that is, I don't like to use the term because you're going to shoot me down, a sure bet. There's nothing like a sure bet in the market, but as close as you can get to a sure bet.
We think the platinum sector, I mean, we're bottom-up analysts, but if you look across most of the stocks there, Amplats is our preferred pick. We think that's looking pretty good. I mean, some of the other stocks we really like Grindrod, Standard Bank, a lot of those stocks have rallied, avenged. They've all rallied to a point where we're not quite as excited about the valuations. The platinum sector is still, as you see if you watch the stock price every day, on the way down. So we think that's
some $30 fall in the platinum price as we speak.
Yeah, but fundamentally, we think that the platinum price, it has a fundamental underpin due to the supply and demand constraints. All the stories behind it. So we think fundamentally it's a much more exciting sector than something like iron ore, which is trading at a massive premium.
And your thoughts on Amplats?
Gutsy. Very gutsy, yeah.